The news hit the wires like a punch to the gut. Moody's, one of the big credit rating agencies, knocked down the US government's debt rating. They said our AAA rating was no more. Now, it's AA1. This isn't just a small change, it's a signal, a warning. The people lending money to Uncle Sam are getting nervous. They are seeing cracks in the foundation. This isn't the first time the alarm bells have rung. Smart people pay attention to these signals. The ignorant keep their heads in the sand. This downgrade wasn't a bolt from the blue, it was more like the other shoe dropping. Standard & Poor's, another big rater, already cut the US credit rating way back in 2011. Then, Fitch Ratings followed suit in 2023. Now Moody's has joined the chorus. 3 strikes. Are you starting to see a pattern here? The so-called risk-free investment, US Treasuries, is looking a bit riskier these days. Let's talk numbers. Big, scary numbers. The US national debt is now a staggering $36 trillion. Trillion, with a T. That's hard to even imagine. To put it in perspective, our total economy, the GDP, is much smaller. The debt is now 124% of our GDP. Think about that. It's like owing more on your credit cards than you make in an entire year. And then some. How long can that last? Not forever. This isn't sustainable. It's a ticking time bomb. And what about the interest payments on this mountain of debt? They are crushing us. We are spending nearly $1 trillion a year just on interest. That's money that could be used for roads, schools, or tax cuts. Instead, it's going to bondholders. To people who lent the government money because the government couldn't live within its means. This interest payment is one of the fastest growing parts of the federal budget. The US dollar is the world's reserve currency. Or is it? And for how much longer? These downgrades, this massive debt, they all cast a dark shadow over the dollar's future. People are starting to ask tough questions. Is the dollar really a safe place to store your wealth, or is it an ice cube slowly melting in your hand? The government can print an unlimited supply of dollars. Think about that. Unlimited supply means less value. It's basic economics. Let's look at history. History doesn't lie. Since the Federal Reserve was created in 1913, the US dollar has lost about 98% of its purchasing power. 98%. What you could buy for $1 back then now costs you $50 or more. Savers are losers, especially savers who keep all their money in cash thinking it's safe. It's not safe from inflation. It's not safe from government mismanagement. The recent surge in inflation since 2021 is just the latest chapter in this sad story. The government tells you inflation is under control. They tell you the dollar is strong. Don't listen to what they say. Watch what they do. They keep spending. They keep borrowing. Hold your horses. Why Wall Street isn't running for the hills. Yet. Now before you sell everything and hide under your bed, let's look at the other side. Some experts say this downgrade isn't a big deal. They say, don't panic. They have their reasons. One argument is that these rating agencies aren't perfect. Remember 2008? These same agencies gave top AAA ratings to toxic mortgage securities, the ones that nearly blew up the entire financial system. So their track record isn't exactly spotless. Maybe they're wrong this time too. Or maybe they're just late to the party. Another point they make is that US Treasuries are still the safest game in town, or at least the biggest. There's no direct global competitor for US government bonds as a super safe, super liquid asset. Where else can big countries and big institutions park trillions of dollars? The options are limited, so even if the US credit isn't perfect, it might still be the best-looking horse in the glue factory. For now, this is what they call the Tina argument. There is no alternative. The US dollar also remains king. This brings us to what to do in troubled times. When people lose faith in paper money, where do they turn? They turn to real money. They turn to gold. Gold has been a store of value for thousands of years. Empires rise and fall. Currencies come and go. But gold endures. It's a traditional safe haven. It's not tied to any government's debt or promises. It can't be printed into oblivion by a central bank. That's why gold is surging in 2025. People are seeking shelter from the storm of fiscal irresponsibility and dollar weakness. Gold is a hedge against inflation, a hedge against currency devaluation, a hedge against uncertainty. When the value of your dollars goes down, the price of gold, measured in those dollars, tends to go up. It helps preserve your purchasing power. My rich dad taught me that assets put money in your pocket. Liabilities take money out. Gold, held correctly, is an asset. Paper money, especially in times like these, can become a liability. It loses value. How can you invest in gold? There are several ways. You can buy physical gold, but it is tough to easily and safely store and trade. It is certainly not that efficient of a market when you have to trade with local gold dealers. Then there is direct investment by a gold ETF like GLD. This represents a proxy for gold holdings and is readily available and liquid. It also has an active options market for covered call strategies or more speculative positions. There are also gold-related companies like gold miners, think Newmont Corporation, symbol NEM, or Barrick Gold Corporation, symbol GOLD. These are operating companies that reflect gold's performance indirectly. How about Bitcoin as the new gold standard, or at least a gold alternative? Now let's talk about this new kid on the block, or perhaps the new gold, cryptocurrencies. Specifically Bitcoin. Many people are calling Bitcoin digital gold. Why? Because like gold, it has a limited supply. There will only ever be 21 million Bitcoin, ever. Unlike the US dollar, which can be printed endlessly, Bitcoin's supply is capped. This scarcity is a key reason it's seen as a store of value, a hedge against the inflation caused by out-of-control money printing. Bitcoin is decentralized. That means no single government or bank controls it. It operates on a global network of computers. This makes it resistant to censorship or seizure in theory. In a world where governments are debasing their currencies and financial privacy is shrinking, this decentralization is very attractive to some. It's a way to opt out of a system that many believe is rigged against the average person. Institutional investors, the big money, are starting to take notice. Here we are. The economic world looks to be troubled with no quick solutions at hand. So, the US debt gets downgraded. The dollar looks shaky. What's the average person to do? Panic? No. Prepare. My rich dad always said that times of great change are also times of great opportunity. This is one of those times. It's time to build your own financial fortress, one that can withstand the storms. That means diversifying your assets, not putting all your eggs in one basket, especially not the government's basket. Think about that 5 to 10% allocation to gold. It's your bedrock. Then consider that 2 to 5% in cryptocurrencies like Bitcoin. This is your modern hedge, your digital gold. It's for the part of your portfolio that can handle more risk for potentially higher returns. But the core of your strategy should always be acquiring assets that generate cash flow. Real estate that pays you rent, businesses that make profits. These are the things that build real, lasting wealth, not paper promises from a government drowning in debt. If you want to learn about investing in Bitcoin or other crypto, check out the link in the description, or visit our website evervest.com for free details. Thank you for watching. If you find this material valuable, please like and subscribe to the channel. The content provided in this video is for educational purposes only and does not constitute financial advice. The opinions expressed in this video are based on publicly available information and are subject to change. All investments involve risk, including the potential loss of principal. Past performance is not indicative of future results. Viewers should consult a qualified financial advisor to determine what investments may be suitable for their individual circumstances. The creator of this video assumes no responsibility or liability for any financial decisions made based on this information.